everyone. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning on the program today is Rick Rule with Sprott Asset Management. Rick, thank you so much for joining us.
Colin, thanks for the opportunity.
Following Monday's sell-off in the HUI gold stocks as a whole, I found myself asking if Rick Rule would say that capitulation has finally arrived. So Rick, is this what capitulation looks like?
In the commodities and the seniors, maybe. This is not what capitulation looks like in the juniors. There's no reason, Colin, why we necessarily have to have capitulation, given that the TSXV is off 86% in nominal terms and perhaps 90% in real terms. But this is not what capitulation looks like among the juniors. In the context of the commodity, this may very well be what capitulation looks like. But I personally don't see a resolution of the gold price and hence the gold equities price situation until perhaps Q4 2015.
I've asked you this before, but I'm going to ask you again as things evolve. What does it take for us to hit a bottom in the sector? Is it simply things get too cheap and contrarians come in to buy, or is there some type of an emotional occurrence like a capitulation that has to happen to end the precipitous downfall that we've been having?
Well, that's a very large question, and unfortunately it's a complex answer. I'll start at it. In the first instance, the better junior gold equities are too cheap. The babies are being thrown out with the bathwater, and you're starting to see very intelligent, high net worth retail investors like Ross Beatty come back into the market in a fairly big way. One cure for low prices is, of course, low prices. The second circumstance, and the circumstance that occurred in the year 2000, was issuer capitulation. The best management teams figured out that they couldn't save their way to prosperity, but only to solvency, and began to do market clearing equity issuances, accepting the dilution because they understood that their ability to deploy capital in bad markets exceeded the high cost to acquire it at depressed prices. The third resolution would, of course, be higher gold prices. And I think higher gold prices require simply a weaker U.S. dollar. I say simply because we haven't seen anything resembling a weaker U.S. dollar for 3 years, but that's what it would require. And I'd like to deal with this subject for a couple of minutes, if I might have your leave. I believe that the next interest rate rise, provided it's fairly modest, is already built into the gold market. In other words, people are anticipating an interest rate rise, which is one of the reasons for the recent dramatic strength in the dollar. I don't think that the next interest rate rise will have any measurable impact on the gold price. However, if Ms. Yellen is able to make that interest rate rise stick, and she is able to engineer a second rate rise this year, I think that would be very damaging for the gold price. If, by contrast, this rate rise causes a real weakness in home prices as a consequence of more expensive 30-year mortgages, or if it causes disruption in the bond market or in the equity markets, and she is not able to implement a subsequent rate rise, or, however unlikely, she's forced to rescind this rate rise, that would be very bullish for the gold price. I would draw your listeners' attention to the fact that I think it was Morgan Stanley that said that gold and gold-related equities comprise about 1/3 of 1% of the investable assets in the United States, against a top of 8% in 1979 or 1980, and a median and mean of about 1.5% over the last 30 years. What that means, never mind gold recapturing its former market share among investable assets, but if it recovered to the median or the mean, that would mean a roughly tripling in demand for gold and gold-related assets in the world's largest market, the United States. What I'm trying to tell your readers is that the most important determinant, I think, of gold price is the strength of the U.S. dollar and the hegemony of U.S. treasuries among savers and investors on a global basis. And gold doesn't need to win that war, Colin. It just needs to lose it less badly. The first battlefield will be fought in this interest rate rise and whether or not it sticks and can be extended.
Rick, looking back at your thesis on gold for the past few years, do you ever question your initial thesis and say, I was wrong? Or are you still standing 100% firm behind the fact that commodities will pick up in the near term and this is going to be the place to be for investors?
Great question. I question my theses all the time. And your question presupposes two answers, because I think right now in commodities markets, you need to segregate precious metals from industrial materials. In the industrial materials market, I'm beginning to think that we need a 2 or 3 year resolution of this bear market. We need a resolution that is not fulfilled by demand creation, because demand appears weak in commodities around the world, but rather a resolution that comes from supply destruction. And supply destruction, or the decapitalization of the industrial minerals and energies group, is something that could take 2 or 3 years to resolve. I think the precious metal situation is very different. I think demand creation can be accomplished there as a consequence of a lessening of the hegemony of the US dollar. The place where I fault myself in terms of my estimation of commodities markets in the last 4 years is my lack of ability to understand the acceptance by the investment community and by the savings community of the arithmetic of the US economy. You will remember, Colin, the narrative in 2011 that $14 trillion in on-balance sheet obligations and $65 trillion in off-balance sheet obligations were unsustainable given the level of private savings in the U.S. Those same numbers are now 18 trillion rather than 14 trillion. In other words, the problem is $4 trillion worse. And the off-balance sheet liabilities are now estimated to be $100 trillion. Yet somehow these higher numbers are regarded by the market as somehow more serviceable than they were in 2011. What I think I failed to understand was two things. I think I failed to understand the extent to which confidence in the narrative is more important than arithmetic in the near term. Something that John Maynard Keynes famously pointed out when he said that the market can stay irrational longer than most people can stay solvent. The second thing that I think I didn't understand, and this has hurt many bears over time, is the incredible capacity of the global economy, but particularly the U.S. economy, to withstand shocks. I don't think it's in anybody's interest to continue to punch it, Colin, because the whole set of circumstances that might give some gold bugs cause for elation would be very troubling to the rest of your portfolio. And I'm not one of those who is now or has ever been forecasting a cataclysmic economic decline. I am one who wonders at the confidence exhibited by investors in the global equities markets that seem to trade higher on artificially low interest rate with no real growth going on anywhere in the world, or at least no growth that's measurable in things like workers' incomes. Are there bright spots now? Well, there are bright spots to be sure. The incredible efficiency of the S&P 500, the American companies, who have managed to grow operating margins although their sales aren't increasing. The incredible prudence of chief financial officers of the same companies who took the lessons of 2008 to heart and have transformed what were marginal balance sheets at best in 2007 into absolute fortresses of financial strength in 2015. That good news, however, doesn't, to me, obviate the bad news, the aggregate debt levels at federal, state, and local governments, and the fact that the economy, at least when measured by disposable incomes of average Americans, and by extrapolation, average Europeans and average Japanese and even average Chinese, seems to be stalled. I don't see the reason for the confidence that seems to permeate global markets. And in that regard, I have been away from the market and just plain wrong for 4 years.
Rick, one thing that I've learned over the past 4 years is the importance of timing. You just quoted Maynard Keynes, who has the famous saying about the market continuing to stay irrational longer than you can stay solvent. How much luck goes into speculating? Speculating is obviously a very volatile sector, and your thesis can be correct for a long time, but your luck in terms of when you jump in can be off. And if you don't have enough money left when things turn, certainly you don't get as much of the gains as you would have hoped. In going through 6 or 7 cycles, what have you found about luck?
I don't think luck has had very much to do with my success as a speculator. I think my success as a speculator has come from hard work, tenacity, durability, and solvency. With regards to me personally, Mr. Keynes' presumption doesn't ring true because I came into this down cycle very, very liquid. And I have sufficient liquidity to maintain my own trade for the rest of my natural life, which, of course, is going to be shorter than yours, Colin. Uh, and I certainly myself have the psychological capability of carrying the trade for a substantial period of time. I mentioned the last time that you interviewed me another couple of famous financial seers, George Soros in particular, who said that fortunes are made by finding broadly held precepts that are wrong and betting against them. And certainly in the course of making his $2 billion in his raid against the British pound, he was wrong for 24 months before he was dramatically right. Similarly, John Paulson took exception to the U.S. Mortgage securities market in 2005 and was, if I remember correctly, having to pay a margin carry short mortgage securities of about $10 million a month for 2 or 3 years, an extremely unpleasant circumstance, writing those checks on a monthly basis, before he made 20 or 25 billion dollars. I would argue that luck had nothing to do with Mr. Soros' win, nor anything to do with Mr. Paulson's win. I think it was hard analysis and the willingness to play the game according to the arithmetic rather than playing the game according to sentiment in the narrative.
Thanks for that. My buddy David Skarica flipped over a research piece by Meb Faber, not to be confused with Mark Faber, and it shows the nominal returns on a sector, industry, and country after a 60, 70, 80, or 90% drop. Taking sector as an example, the 3-year nominal return after a sector drops 80% was found to be 172%, and after a 90% drop, you can expect a 240% return over 3 years. As the commodity sector is more volatile than any other, do those numbers seem to line up with your expectations of the returns following this bottom?
They do, in fact, and the phenomenon that you describe is really the author of my fortune. The truth is that this is my fourth major market cycle. The first one I was a victim of. I was young enough that I didn't understand cyclicality. But the phenomenon that I noted in prior cycles, and a phenomenon that was illustrated to me by Ned Goodman, who has been around for one more cycle than I, seems to be that in the TSXV, in the junior resource stocks, whatever inventory you hold over through a bull market into a bear market costs you half. In this particular circumstance, like the circumstance of the early 1980s, the result is worse than that. But coming out of that bear market into a bull market, the intelligent speculator, one who stayed semi-solvent through the downturn, seems to make 500% or 1,000%. And if you take that circumstance, losing half and then making 10 times, over the course of a decade, it's a very pleasant business indeed, although it's highly unpleasant at times like these when you are suffering through the pain. Of course, one wishes that one could optimize one's performance and buy always at the bottom and sell always at the top. But I believe it was Bernard Baruch who described people who always bought at the bottom and always sold at the top as liars, and one must be honest with oneself.
The other day, I charted the HUI versus the gold price and confidently touted to my brother how undervalued gold stocks were based on this ridiculous looking chart. He responded by questioning the validity of my argument, stating there's no reason the HUI cannot go much lower against gold. And costs have gone up considerably to mine an ounce of gold since, say, 2000. So those companies could end up in as bad of financial straits, if not worse, than they were in 2000. I want to get your opinion on the HUI versus the price of gold because it is far below where it's ever been in the past at this point.
At Sprott, we're fairly critical of market cap weighted indexes. We launched our own factors based index, the SGDM, as a consequence of the fact that we didn't want to own the gold equities market in toto, but rather that we wanted to focus our ownership on companies that were growing rather than contracting, on companies that had prudent balance sheets, particularly relative to their debt service requirements, and on companies that had also exhibited some beta to the gold price. So I share your brother's opinion that the broader based indexes, the XAU and the HUI, could have further to fall. We have talked before on your show about the fact that the mining industry and the minerals exploration industry is the author of the lion's share of its own misfortune, gearing itself, if you will, merely to leverage in the commodity price rather than making itself an efficient industry over the last 40 years. The market is beginning to segregate and is beginning to award higher multiples by any measurement metric to companies like Franco-Nevada, like Goldcorp, and like Randgold that have exhibited corporate efficiency. But there is a lot more room for corporate efficiency. And so I believe that your brother's statement with regards to the HUI may be very prescient, I think. I believe, as has been in the past, that if gold were to lose the war against the US dollar less badly and that the gold price were to go up, that rising gold ship would to some extent float all ships. But I don't think that prospect is enough to cause people to buy the waterfront. Rather, people should buy more efficient, more prudently valued companies and try and segregate between the good, the bad, and the ugly in the gold equity space.
On general equities right now, Rick, yesterday 39 companies on the S&P 500 reportedly hit a 52-week low, and that highlights the fact that the index is being held up by a few major companies such as Apple, but really overall the growth of the US stocks is not as good as some people still perceive. What do you think is going on in the US equities right now? I know that you think they're overvalued, but this year we haven't really seen the equities go up, even though a lot of people think that they've continued their bull market.
Well, I would like to correct your statement that I think they're overvalued. I don't pass a judgment on their valuation because I'm not a general market analyst. I don't know how to analyze the automobile sector or the supermarket sector. I might be able to analyze the financial services sector, but that would be a subject for a different phone call. What I do believe, however, is that I am troubled by virtue of the fact that while operating margins are very strong, top line growth, revenue growth has been very anemic in the U.S. economy. And I don't understand how the companies are going to be able to continue to drive margins and drive profits without driving sales. There are some bright spots, of course. Automobile sales are beginning to pick up. New home construction is beginning to pick up, but pick up from very, very tepid levels. What I think has driven the equities market in the United States is simply momentum in the first instance. It has gone up because it has gone up. The relative attractiveness of the dividend yields in the S&P 500 relative to deposit interest rates, which are totally anemic, and the fact that companies, rather than investing capital in productive growth in the face of stable sales, have spent billions and billions and billions of dollars rightfully returning capital to shareholders by way of buybacks and dividend yields. In other words, they have decapitalized themselves for the benefit of shareholders, and shareholders have enjoyed that return of capital.
Rick, one further question on gold and gold stocks. I find more and more people afraid to call a bottom at this point or state that a new bull market in the mining stocks is imminent. And that's probably a natural reaction to having called bottoms several times over the last couple years. What's the most definitive statement you're willing to say about where we are in terms of the mining stocks as a whole turning around?
The most definitive statement I guess I'd like to say is with regards to the top 10% of the juniors, even including capitulation, I would say we are within 20 or 30% of a bottom, and we are 500% away from a top. In terms of when this blessed time might occur, I have no earthly idea. I do know that, as I say, this is my fourth cycle. And in every previous cycle, there's no reason why past has to be prologue, of course, but in every previous cycle, the bear market was the author of the bull market. This has been a particularly treacherous bear market. And just as bear markets are the authors of bull markets are the authors of bear markets. And the reason that this has been a particularly treacherous bear market is that the last bull market was particularly generous. Market capitalizations and the cost of capital got really out of whack. Investor expectations and management expectations got completely out of whack. And the truth is that we need to exercise all those sins from the market that we inhabit. Most of those sins, I think, are in the process of being exercised right now. As difficult as a capitulation would be for everybody who sees it, and it would be difficult, in my experience, capitulations represent the very, very, very spiky bottom of a bear market. And this bear market has gone on long enough to even wear me out. I would welcome capitulation because in my experience, capitulation, while violent, is of short duration and marks the beginning of the next bull market.
Rick, on that note, thank you so much for joining us. Unless you have any other ideas or comments to share with our audience, I would like to say until next time, and thanks so much.
Well, I would like to share one thing with your audience, with your permission. One of the important functions that an old veteran like me can provide in a market like this is a steady hand and adult supervision, hand-holding, if you will. And I have clearance from the powers that be at Sprott to offer the listeners at Palisade Radio a no-obligation review of their junior mining stocks portfolio, if they'd like. They can email me those portfolios at rrule, at sprottglobal.com, and I will send back an evaluation. It won't always be right, but it'll be it'll be the best guess of an old pro and his team. It's very important at market bottoms or at near market bottoms that one prune one's portfolio, get rid of the losers that one has been hanging on to because he or she is afraid to look at them, and redeploy the capital into companies that have the best chance of prospering in the recovery. And so that's a public service. Absolutely no obligation.
Rick, that's very kind of you to share your personal email with our audience. I'm afraid you might get a flood of emails coming in, so good luck with those. Thank you for joining us.
I look forward to it, Colin. Thank you for the opportunity. Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?